How you doing, everyone? This is Jason Lutz with Rate Mastery. I have with me the famous David Shirmeyer of Sigma Research. David, are you there?
I certainly am. Good to be with you guys today.
Very good. Actually, before we get started, as always, can someone, anyone, just let me know that you can hear me okay and you can see my screen? Once I pull up the questions here. Oh, good. All right, so we're good. We're ready to go. Um, Again, thank you everyone for jumping on this webinar. We have quite a few things to talk about, so I'm just going to jump right in it. David, I want to ask you about, you had actually mentioned in your Sigma research report this morning, and you've talked a lot about it actually, about your um, love affair for Barney Frank and Chris Dodd and how you think the world of them. But you mentioned some interesting things this morning about maybe some action coming out of Congress to maybe, I don't know, roll back? Is that maybe the right word? Dodd-Frank Act?
Well, I think eventually that it'll probably be rolled back to some extent, but Dodd-Frank was a piece of legislation that was pushed through in a period of panic, literal panic in Washington as the housing market collapsed and just about all the big banks were right on the teetering of going down under. They let Lehman go, as of course everyone knows. And Barney Frank in the House and Chris Dodd in the Senate, uh, in their heat of the moment, came up with a piece of legislation that was so bad, in my opinion. It wasn't well thought out, and it didn't have any direct specifics as much as you might think that they would have had. They just left it up to what I call the bureaucrats, the people that are in Washington that put all these pieces together all the time, regardless of whether it's a Republican administration or a Democratic administration. But one of the real problems that I had with Dodd-Frank, and I suspect anybody in the real estate business, whether they're real estate agents or loan originators, loan officers, heads of mortgage companies, what have you, anybody whose career is involved in mortgage lending, uh, couldn't come away with that with any degree of uh, anything more than disdain, if you might, or at least I'll call it disdain. They made the banks. One of the things that's coming out here recently, and it's really coming from the FHFA, as most of the listeners here probably are aware, the Mortgage Bankers Association is currently holding its annual convention in Las Vegas, at which point FHFA, Mel Watt is his name, I think, or Watts, the guy that leads it, made a big speech, and this is where you usually get some decent announcements if there's going to be any, and he pointed out that they're now realizing that they have to change some of those regulations that the banks have been faced with, which one of was that if you didn't have a 20% down payment on a mortgage, that the lender that held the loan, and now of course I'm talking about the people that are, or the companies that are holding the big products like Chase and Citi and BB&T and so on and so forth. Those folks had to keep, as Barney said, keep skin in the game, meaning what he wanted, and Dodd also agreed to it, that if you're going to make a mortgage loan, then you are going to have to keep some money in the pot forever. And that really put screws to any loans that had less than 20% down payments. Their credit requirements became so obnoxiously out of whack that a lot of people that may have wanted to buy a home weren't going to be able to do it because of that. Now, although these new regulations haven't been formally promulgated or put out yet, what's going to happen is that 20% rule is going to be taken away, so that it'll allow a whole lot better opportunity for banks to stay in the game. And Jamie Dimon from Chase jumped on that issue here during the conference or the convention, and said, yes, the underwriting has been way too tight, and it's been a real drag on our economy. So we're seeing some light at the end of the tunnel, and that stuff has all just kind of come about in the last few days or so. So we'll just have to wait and see when the details are put out. But they're even now talking about not putting extraneous pressure on banks that hold loans with 3% down payments. Mm-hmm. In other words, they're relaxing a lot of the standards that have hamstrung the housing industry since 2008.
Right. Yeah, and that's, I mean, do you think that this will have, I don't know, an immediate impact on the product availability and I guess maybe pricing as well, because we have this contingent liability, right, that is hanging over these banks' heads.
Yes, exactly.
So pricing, I guess, relative to the MBS market would improve as well?
I think so, yeah. But it's probably going to take a few months for all of that to disseminate down. You know, the bureaucracies in Washington are so huge that by the time they actually get it to the operating perspective, it's probably going to take a few months, but it's got to help. I mean, there's no doubt about it.
Right. I guess to switch gears a little bit, because I just brought that up as something you wrote about that seemed to potentially impact real estate quite a bit and mortgage lending. But one of the things we wanted to talk about, and we mentioned in the email, is the fact that it seems like everywhere we turn, right, on the news and CNBC and everywhere, it looks like the economy is tanking, or it's going down for the second time. Is this something that you think is a fact with China and the rest of the world, it seems? And is that really happening in the U.S.? Are we going to be able to sort of I don't know, weather the storm, or is this something that you can see affecting the U.S. as well?
Well, it's affecting the United States, particularly in the last year, or even, well, let's say the last year, but it really has only become a headline issue within the markets over the last 6 months or so. And that, a lot of that had to do with the sanctions that we put on, or that Europe put on Ukraine, or put on Russia because of the Ukraine situation. And since that time, it seems like we started focusing more on what was going on in the European economies, and things were not good in any instances. I think everybody should remember Greece and Italy and Portugal and Spain, all those southern European Union countries were, well, you know, Greece essentially went broke. And now what we're seeing in the repercussions of all of this is that the European economy is slowing in two fronts. One, of course, the economic conditions, and where it really began to get a lot of attention to us and probably to everybody else in the world is what was happening in Germany. Germany's economy was holding that whole basket of countries together. And all of a sudden, we start seeing economic data month after month coming from Germany that their industrial production was slowing, that their business confidence indexes were declining. You know, it just wasn't looking good. And if Germany gets a little bit wobbly, or if the perception is that they are getting a little wobbly in terms of their growth outlook, it'll bring the whole European situation, and has been, and brought it right under the microscope. What it does to the United States, and it's not just Germany, we'll talk a little bit about China in a second, but we're in a global world now in terms of our economies. The idea that the United States is one economy and Europe is another one and Asia is another core area of the global economies, that's over. It's all one great big global economy now, and we have different sectors of the economy. If you want to kind of look at it like, take for example in housing, if you have a strong single family here in the United States, a strong single family business or economy, and multifamily is suffering in terms of the construction, it all meshes together as to one picture, and this is what we're seeing now. And I don't really think a lot of investors really understood the magnitude of and the depth of that we're now beginning to have to deal with. Europe is in trouble. Because of the way they're organized, the European Union doesn't, I think I mentioned this in the report this morning, they're not like their central bank. The European Central Bank doesn't have the same power or the same influence on their economies as our Federal Reserve, primarily because there are 19 different countries involved in it. We got 40 or 50 states, but we're all under one roof, whereas over there, you got the governments of Italy, Spain, France, and so on and so forth. So will it drag the U.S. economy down? I don't think it's going to drag the economy down, but until Europe can get their act together and get a little bit of an improving growth outlook, what it does is it's going to stymie our growth here.
Right.
We'll still grow, but we can't grow in the magnitude that the stock market has kind of shown us with the huge improvement in the stock prices over the last 4 or 5 months. But our growth can't grow as rapidly as it can grow because we can't export. And it's the same thing with China. Mm-hmm. China, I saw a thing last March on 60 Minutes, and then they replayed it again sometime this summer about their housing market. If you had seen that video, anybody that's listening to this would have, my mouth dropped open. They were building so many high-rise residential developments all around that country, and people were buying them to speculate on them. Nobody was moving into them. Mm-hmm. This was a frightening video or segment. And their economy, it's going to grow at about 7, I think their last data came out a couple of days ago, 7.3% GDP growth. Well, we'd love that in the United States, but that's about half of what their growth had been over the previous 10 to 12 years. So the combination of our decent economy against the softer global economies is going to keep our economy from doing what it's capable of doing within our,
sure,
with our capabilities here.
Yeah, I mean, they've been calling for China to have this huge, real estate bubble tumble, kind of like the U.S. went through for quite some time. And you mentioned in your report, I mean, they've had 5 or 6 months of downturn in prices in real estate in China. So they're feeling the pain in a big way at this moment, yeah?
Well, I don't know whether CBS puts those in their archives where one could bring it up and watch it again on, through your computer or something. But when I saw that thing, I wasn't even interested in watching it. It came on this summer about 8 o'clock after a football game or something, and I sat and I started to watch. I couldn't believe it. I mean, I even called a few friends of mine while it was on, guys in the business, said, turn this thing on, you got to see this. And right. it was rather frightening, and I put a chart in one of our reports the other day that illustrated that fact. I got it out of the Wall Street Journal. But yeah, they're struggling. We're struggling, but we're fine. We would be a whole hell of a lot finer, of course, if we could get the rest of the world going. So,
right.
But I don't think it's going to drag our economy down. It's just going to keep it from going at the magnitude and at the pace that we have the capability of doing if the rest of the world was with us.
Get it together, yeah. Well, you mentioned this before about our strong, I guess, Fed policy as a relative to um, European Union and whatnot. What I guess along that same line. And by the way, if you have any questions as we're going through this, just put them in the question box or the chat box, and I will ask David. But what's your view and what it is that the FOMC will do in the next couple 3 weeks with QE3? I mean, every now and then you hear that they're going to extend it, and then you hear them saying absolutely not, never in a million years. Um, you know, assuming, I guess. Well, first you can tell us what you think they're going to do, but I guess more
Well,
importantly is this is yet another headwind that we're going to have to kind of deal with. Given the fact that we've been used to this steroid in the economy for so long.
no, I don't. I don't see it as a headwind. And by the way, the meeting is actually next Tuesday and Wednesday, at which point we'll know what they do about ending this QE3 on Wednesday afternoon, a week from today. Uh, my belief is that they will just stop it. I think there's only 15 billion a month being purchased now. They've been cutting back on the QE3 since early this year, or late last year actually. So there's not a lot of money in that pool that one way or the other in terms of their buying $15 billion of MBSs and treasuries. If they elected to not terminate it next week, my view is that that will send a real chill to around our marketplace, probably help our interest rate markets, because it would indicate or suggest that too many of the FOMC members or Federal Reserve policymakers, including Janet Yellen, are more worried about the economic outlook than they're suggesting or indicating. I don't really see what value anymore there is in the Fed continuing to buy bonds and mortgage-backed securities in context of what help it has for the economy. I mean, they've been doing this now. This is QE3. We had 1, 2, and now 3. And it really, maybe it's helped. We don't know because there's no way to replay it without their involvement in it. But I think they're running out of bullets. I made the comment in one of the writings. They still have BBs, but they don't have any 3006 ammo to use anymore. So if they were to come out on Wednesday afternoon next week and say, no, we're going to leave that, we're going to continue the QE as we see it now, they're going to have to explain why. And any explanation that they give has to be a negative explanation as to the forward impact.
Sure.
Doesn't it? I mean, you just think about it. If they keep pumping money, fiat money into the economy, and the economy isn't growing, and if they take this minor amount of money that's still left in QE3 and continue to do it, it's got to say to investors and traders and so on that, hey, the Fed's not a happy camper. They think if they pull this small amount of money away that we're all going to hell.
Right. Well, what's
So
weird though, and maybe you could talk to this because when they started, quantitative easing, all we kept on hearing about is, oh, well, we're going to have crazy inflation. Wait till the economy comes back just a little bit, and we're going to have runaway inflation, inflation, because obviously, just like you said, we're printing dollars essentially. And now all you hear about is, holy crap, I hope we don't have deflation because we're in deep trouble. The whole, the European Union, they're having deflationary issues. We have the price of oil coming down, which I technically always thought was good, but now they're talking about really in this case it's bad because of this, that, and the other thing. I mean, what is sort of your feeling about this inflation and deflation conversation that seems to have pivoted quite a bit over the last few months?
Well, it certainly has, and that's a good point, and it really stemmed or started in terms of being a headline type of thing that the markets are talking about. It started in Europe. Mario Draghi has been worried, and everybody else over there, that their inflation is not only not going up, it's going down. I think the last read they had is 1.3% annual rate of inflation. Ours is about 1.6, 1.7%. But they can't get the economy going, and if they can't get the economy going, or if the economy doesn't go, I shouldn't say they can't do it. It's just it has to, somehow it has to turn around. Otherwise, it's going to get worse in terms of the actual economy itself. Then prices will begin to decline, and once continue to decline, and once they get to the zero inflation rate, then you're facing something that we haven't faced in this world in my lifetime, and I'm an old trooper, but the Fed wants 2%. They've been saying this for years, and we're not there yet. And until you get some pricing power in the markets, businesses can't improve their prices. They can't do it because they can't get the prices. And wages aren't going to go up, and if the wages are not going up, as everyone knows, so without wage increases or the anticipation that I'm going to get a raise next year, it feeds on itself.
Well, and I guess
it's self-feeding drag.
Well, I mean, and I guess to your point, what is it that could be the impetus for this economy to get going? Because we've had the quantitative easing, and by all accounts, it really hasn't worked, right? And we're not getting the kind of growth we need. We certainly haven't gotten the kind of job growth that we need and the type of jobs that we need. And that really is sort of the, I don't know, the only thing that's been on the table. What is it that could get the economy going? Reducing taxes, which certainly hasn't been tried here recently. What is it, in your opinion, that could finally push this economy along, get in unemployment, get people back engaged with the economy? And do we sort of face the consistent problem where once the economy does get going and once interest rates do start to kick up, now we have this huge debt that we're carrying, and now we're going to have to reservice the debt, and now we're going to have that drag on the economy? I mean, is this a vicious cycle that, in your opinion, is almost impossible to get out of, or can you see a way that they can finally get this economy going?
Now that question has to be delivered to one of the high-powered economists that think into those kinds of things, although as far as how all that ties together, it's very complicated. But I would tell you the answer to what's going to get this economy going is housing. And it staggers me. I've got out of the service in '62, and I got into the mortgage business right thereafter, and I didn't get out of the mortgage business until, what was it, '82. And I've gone through, I don't know how many recessions in my lifetime, or anybody my age has, and every single one of them since the Second World War, the way out of it that really catapulted the economy back on its feet was the housing sector. Mm-hmm. And because of our friend Barney the Frank, I don't blame Chris Dodd so much, but nevertheless, that piece of legislation was totally nasty. Well, I don't even know how to describe it without swearing, but it was bad, and we need to get the housing market together. Young people, they're not interested in buying a home right now. Part of that is because they don't see any economic benefits to it. Hell, you used to be able to buy a home, and even with very little inflation, the value of that home would grow. Mm-hmm. And that's not the case today. But the debt problem is a serious problem, and how we're going to tackle that, I don't know. It surpasses what I would consider my knowledge level. I'm a trader. I'm not an economist, and we're just going to get on the horse and ride it until it falls over.
All right. Well, yeah, and the other thing that we mentioned we wanted to chat about, which I suppose if this comes to fruition, David, and everyone gets Ebola, it'll be really a smart move that the U.S. accumulated so much debt because we won't have anyone to pay back. But
oh, Jesus.
but what's sort of your feeling on Ebola, and is it really affecting the markets, or will it affect the market? Because a week ago, if you had CNBC or Fox or any other CNN, it's all we heard about: Ebola, and how Africa is decimated, and Europe could be the next, and U.S. and these couple of Ebola viruses, and how horribly devastating it could be for a country. Now you barely even hear a peep about it. I mean, what's sort of the market mindset on that?
Well, my take on it, obviously, it's a serious problem from a health point of view and from a sociological point of view. There's no demeaning or diminishing the potential problems that Ebola could wreak on the world, particularly if it mutates airborne. Well, it hasn't been able to do that yet, thank God. But it was just one more ingredient that went into the soup, so to speak, because the markets were getting ready for a major correction. For the last 2 months, I've been looking for the stock market to really start to pull back a little bit. And frankly, at this point, it hasn't. But, it was just one more thing in the mix for a few days. No one really knew. Now we know most of those people in Texas have passed the 21-day period of time, and they're Ebola-free, and it's not spreading. The governments are getting more involved in it. And, it's a psychological factor, let's put it that way,
Right.
more than an economic factor at this point. It
Okay.
was not one of the things that caused the stock market to roll over last week like it did.
Right. I mean, and I guess the fear really was on an economic level, apart from the devastation that it has on the families and whatnot to get it, is that it'd be kind of like the next bird flu, right? That people would be, holding up in their house, buying everything
yeah.
online, and next thing you know, that's the piece that would tear down an economy that's already weak to begin with.
And certainly that was something that everyone had to think about, investors and traders and so forth. If this thing spreads, even if it doesn't explode into a major epidemic, the fear factor would have really been serious. And,
Sure.
But that mixed in at the same time with problems from the European Central Bank and their economies, the Ukraine-Russian situation, and just an overextended, from a technical point of view, an overextended stock market. And all of that combined into kind of like one great big zit. And
That's a pleasant thought.
I know. But it just blew up. And Ebola was a part of that, but I don't think if you wanted to take all the pieces out, excuse me, and segregate them, that it would have been very high up on the list.
Sure.
And now it's, at the moment anyway, it seems to be getting more under control with our ability, the world's ability to kind of handle it. But you would just have to keep an eye on it. It's a fearful thing, but it didn't bother anybody outside of Dallas, I don't imagine. But the possibility was there,
Right.
and that's why I thought it was critical, but not as critical as maybe some people thought it might
Right.
be.
Right. Okay, well, we're actually bumping up against the time. We have a couple of questions.
Let me point out one thing, though, if you don't mind me interrupting.
No.
Someone on this chat question put apparently what the email address is to get that uh, 60-minute thing we were just talking
Oh,
about.
someone was nice enough, Will, to find it for us. So already did. I already sent it to everyone.
Did you send it to me?
Um,
I want to watch it again.
all right,
No, I don't. No, no,
I,
I just think it's something that if a person has the time to get some perspective or some feel for what, now, we know what's going on here. We got a sense of it, each of us as individuals, but that thing can wake a lot of people up.
yeah, I just posted in the chat as well. Um,
Okay.
so you should have it,
All
David,
right.
and everyone else. And one last question, David and Pete asked this, and you kind of alluded to it earlier, but um, his question is essentially, do you think that underwriting standards are going to be relaxing a bit over the next year or two? I think you were basically saying with some of the new happenings with Dodd-Frank and sort of the mindset shift that's occurring, that your answer would be yes.
Yeah, if they don't, our society that's been based on housing ever since the end of the Second World War is going to have to find another
Catalyst.
anchoring point. I, yeah, they're going to have to. We had no problems, my lord. I mean, other than what went on in 2001 and through 2005 and 6, and a lot of that was predicated on Wall Street. They found a market that they could sell junk to,
Right.
and they sold the junk, and at the same time were the lenders, and I'm talking about the loan officers now at the ground level. There was so much predatory lending going on. A guy that should have gotten, let's say, hypothetically, a 6% loan got talked into a 7% loan so that the LO or the company could pocket more money. But yeah, they have to get back. We had no problems with underwriting of any great consequence. Sure, there were foreclosures. FHA was the most profitable government agency clear up through about 1998, I think. They were the only profitable one.
Hmm.
And Fannie and Freddie were in the game a little bit, but everything was chugging right along until the Wall Street boys and girls decided that there was a market that they could go around the world and sell literal junk. And the way they did it is something that we could spend another half hour on, is I could lay it out to you how it happened. But Barney, he wanted to blame the whole damn thing on loan originators and a couple of banks. But no, it's got to come down.
Okay.
And I think they're finally waking up to it.
Very good. Um, all right. Well, we're right up against the time. David, thank you so much for taking the time to talk with everyone. It was informative as always. I'm actually going to take maybe 2 minutes and tell you about a new product that we're coming out with, and you'll get emails on this weekend. If your company is paying for 1003 magnet, LO magnet, you're going to see this, which is super cool. Just want to show you guys real quick. If you're not interested, just jump off. No, my feelings won't be hurt, but I will be having an actual webinar on this because I think it solves a fundamental problem. So what a lot of originators have. So let me just jump into it real quick. We have a David. I don't. You haven't seen this. This is.
Yeah, go ahead. Okay.
No, yeah, I don't know if you've seen this, but this is pretty cool. So what we're offering is our members, 1003 Magnet members and LO Magnet, is a new little like widget that they can put on their website that sort of entices consumers to put in their name and email address into a form, which you'll see on the right, that will be able to send out the weekly rate insider, the daily rate insider, and a lot of the marketing that many of the loan officers on the line are familiar with, so that these websites that some of them look really cool. I just grabbed this one here. That's a beautiful website, but the reality is that when a when a consumer comes to this website, there's really no reason or no ability, no sort of squeeze page or enticing them to put in their name and email address and phone number so that the loan officer can ultimately reach out to them. So what we do is you can put in one of these banners that has a catchy sort of slogan to interest them about what it is that you can provide or what it is that you're going to be providing on a daily or weekly basis in terms of marketing and information about what's happening in the marketplace, right? The direction of rates and why. So keep a lookout on your email this weekend. I'll be sending out an invite to a webinar where we'll go over this in way more detail and why it's so effective to have a squeeze page like this on your website. It's just going to be included in the system. But if you have a website and you don't have a effective data capturing tool, then there's not a lot of reason to have it, because what you want is to get buyers out of it, right? So anyway, David, again, thanks for jumping on for our 30-minute webinar.
It's my pleasure. I enjoy doing it, and if I can be of any help, let me know.
All right. Thank you, guys.